Welcome to This Explainer. Today, we're diving into what is honestly one of the most fascinating and frankly massive disconnects in the market right now. We're looking at Carnival Corporation, and the big question here is simple. Are we looking at a deep value opportunity, or is this just a massive value trap? 0.06. I really want you to keep that number in mind, because this single figure is the absolute core of today's analysis. Seriously, we're looking at a stock that is exhibiting explosive growth, yet somehow it's being priced by the broader market as if it's completely standing still. I'm talking about Carnival Corporation, trading under the ticker CCL. Right now, Carnival is sitting on a massive 58.7% earnings per share growth trajectory. I mean, that is huge. But despite that incredible momentum, its valuation multiple is basically sitting in the basement, at just 12.5 times its trailing earnings. This is literally the definition of a market paradox, and we're going to unpack exactly why this is happening. Section 1, the value disconnect. What the market is missing. Let's dive right into it. When we compare Carnival to the broader consumer cyclical sector, the discount is just staggering. On a trailing basis, Carnival trades at 12.5 times earnings, compared to the sector median of 18.2. And looking ahead, the forward PE is just 9.8, against a sector median of 15.4. So across the board, Carnival is trading at a 31 to 36% discount. It's functionally the cheapest of all its peers. Which brings us right back to that 0.06 number. That is Carnival's PEG ratio, which, if you're unfamiliar, measures the trade-off between price, earnings, and expected growth. Generally, a PEG of 1 means fair value, but a PEG of 0.06? You guys, that's like being offered a high-performance sports car for the price of a rusty bicycle. The market is pricing in zero growth, which seems completely disconnected from reality. Moving on to Section 2, catalysts for growth, the engine driving the turnaround. So Carnival actually has 4 fundamental forces pushing its recovery right now. First, they have incredible pricing power. They're seeing a 12% increase in daily yields compared to 2019. Second is fleet modernization. By 2028, 60% of their capacity is going to be on new, highly fuel-efficient platforms while they retire their older ships. Third, they are aggressively paying down their debt. And fourth, they're unlocking an entirely new demographic of travelers. And speaking of that new demographic, get a load of this stat. 40% of 2026 bookings are from first-time cruisers. Millennials and Gen Z are absolutely flocking to these ships, particularly their expedition and luxury brands. It completely shatters that old stereotype of cruises being, nothing more than a floating retirement home. The younger generations are adopting this vacation model, and they are adopting it fast. And the reason this matters so much comes down to the total addressable market. Right now, global cruise penetration is a tiny 3.5% of the overall vacation market. That is a $120 billion market. Carnival's long-term target is just to reach 5 to 6% penetration. And even that small, incremental shift in global vacation habits, that translates to massive compounding revenue growth for the clear industry leader. Next up, Section 3, the competitive moat, scale and superior economics. When you look at their income statement, the inflection point is incredibly clear. We're seeing a 32% compound annual growth rate in earnings per share. By 2026, diluted EPS is expected to reach $3.22. Revenue is growing steadily, sure, but their EBITDA margins are expanding by 600 basis points. This shows that those newer ships and that pricing power we talked about are drastically improving their bottom line profitability. And this really hits the nail on the head for the core thesis of our explainer today. When you stack Carnival up against Royal Caribbean and Norwegian, Carnival is holding its own or outright beating its peers. I mean, Carnival's free cash flow yield is a massive 11.2%. That's more than double the sector median. Its return on equity is 14.5%, and yet it trades at a fraction of the multiple of Royal Caribbean. This is despite Carnival having 25% lower unit costs, all thanks to the massive scale of its 87-ship fleet. All right, Section 4, the reality check. Addressing the elephant in the room, we got to look at the risks. So the absolute crucial point here is how they are managing this balance sheet. During the pandemic, debt peaked at a staggering $35.2 billion. That is a lot, but they've already reduced that current debt down to $29.4 billion. They're using $1.5 billion in discretionary free cash flow every single year to rapidly pay this down. Their target? To drop leverage to 3.0 times by the end of 2027, putting them on a really clear path to an investment-grade rating upgrade. Now, aside from debt, there are obviously other bear case scenarios to consider. There's a 35% probability of a fuel price spike, but Carnival mitigates this by already having 60% of their 2026 fuel hedged. Plus, remember, those newer ships are 20% more efficient. Then there's a 30% chance of a consumer recession, but they have 12 months of booking visibility locked in. Geopolitical disruption? They have flexible deployment across over 700 ports globally. So yes, the risks are real, but their concrete mitigation strategies are surprisingly robust. Bringing it all together in Section 5, the investment verdict. Asymmetric risk and reward. What we have here is a highly asymmetric risk-to-reward ratio. Let's break it down. Even in the bear case scenario, factoring in a recession or a fuel spike, the fair value sits at $28, which is still a 9% upside from current levels. The base case, built on steady pricing and their current deleveraging pace, puts the fair value at $42.50. That's a massive 65% upside. And the bull case? That stretches all the way up to $58. Now, the market isn't going to wake up to this overnight, but there is a clear chronological roadmap for how Carnival gets re-rated to that base case. First, the 2026 earnings surge proves the profitability model is working. Next, the rapid debt paydown triggers an investment-grade upgrade in 2027. And finally, with the balance sheet all cleaned up, 2028 opens the door for massive share buyback authorizations, utilizing that $1.5 billion in discretionary cash flow. So we come right back to where we started, but now we're armed with the data. With a 65% upside in the base case, explosive 58% earnings per share growth, and a valuation that prices the company as if it's dead in the water, the ultimate question is this: is the broader market completely missing the boat on Carnival Corporation? It's a highly compelling thesis and absolutely one worth investigating for your own portfolio. Thanks for joining me on this explainer, and keep learning.
All information provided is for educational purposes only. Always consult with a qualified financial advisor before making any investment decisions.
Thank you for watching. Please like and subscribe to our channel.